Good evening, this is Duane Lowry for the DPP Grain Desk on Sunday, October 6th. It's currently about 4:25 in the afternoon. The outlook tonight looks like we're going to be lower. Number one, we come into this time of the year, that's just generally the default setting. Number two, trader sentiment still very bearish. Harvest activity was slowed during the weekend because the rain system is moving through, but you look ahead over the next 2 weeks, any weather disruptions will be minimal. Harvest will advance rapidly here over the next 2 weeks. Yield reports tend to be better than what people expected or better than worst fears in the areas in the west. Other areas are as good as expected or better than expected, so the market's absorbing that type of trader talk as well. That was certainly in the markets last week. Other than Monday and maybe Tuesday, markets recovered well. You stand back and look at things here. The wheat markets rallied 60 cents from the bottoms that were made in early September, and they were still trading those levels at mid-September. From that level, we rallied about 60 cents. The short-term technicals in wheat are vulnerable to some sort of setback. Support levels are probably 15 to 25 cents below where we traded Friday. So you've got that type of weakness potential here in wheat, and still be well supported and may still trade to higher levels than where we were at last week. But short term, I think indications look like we're vulnerable to some setback there. Corn market recovered and had a corrective bounce over the last 3 or 4 days. The highest settlement of the week occurred on Friday, but that was still down from the previous week because the market was down so much on Monday. So you're looking at, after having 3 days of corrective bounce in all of these grains, I think you're looking at some vulnerability to weakness. I don't think there's a lot of farm selling going on. I don't think there will be throughout the harvest season, especially in corn. You might find the farmer a little more willing to sell soybeans, especially if his yields are better than expected, and especially if he plans to store a lot of corn. So you've got all the markets a little vulnerable to weakness tonight. Soybean market, Friday's levels are probably 30+ cents off of their lows made over several days ago. I think there's a chance that we get some setback there. I think it's possible, if not probable, that corn and soybeans will violate last week's lows. That's a fairly decent setback from where you're at on Friday. And the wheat, I've already mentioned, you probably got 15 or 20 cents of corrective potential there. So all the markets are set up for some sort of weakness here. I don't find any of the corn or soybean prices to be attractive when I look ahead over the next 6 months of where I think I will have an opportunity to make sales. I don't think current levels are very attractive at all. But the market still needs more time to absorb the breakdown of the charts from the report from the USDA last week. It needs more time to absorb the harvest pressures and things of this nature. But like I said, none of it looks like a very attractive sale. I think the producers will get better selling opportunities sometime over the next 6 months rather than make sales now. I think the biggest news item here continues to be what's going to happen with the government shutdown. We have the shutdown. I think there's been a general belief that, number one, we wouldn't have the shutdown, or two, if we did have the shutdown, it wouldn't last very long. There's been a general belief that there is no way the Congress would ever allow the U.S. to default on its debt, and the marketplace has wanted to take a fairly optimistic view of the possibilities, accepting the fact that Congress is going to take us to the brink, but they didn't think that we'd go over the cliff, so to speak. I think that the marketplace is going to look at what's going on in the rhetoric between in Congress, and I think there's a good chance that they're going to look at this and elevate their concerns that, you know what, maybe these guys are going to take us into default. Maybe they're willing to allow it to go to default, or maybe we're going to go to default because neither side wants to surrender. Maybe you look at it that way. But the bottom line is, I think there's going to be greater and greater concern that they're going to allow this to get to the brink of default, maybe even allow it to be the U.S. to default before we correct it and get the situation under control. That sets up a stage where the stock index is very vulnerable here. We've sold off 700 points off the Dow, off the peak made not that many weeks ago, and you don't have to break the Dow very much, and you'll be at the cheapest level you've been in a few months. And I just wonder if the marketplace doesn't have a vulnerability in the stock index here, where we flush down to levels that negate, half or even all of the gains made in 2013. That implies 1,000 to 2,000 point drop in the Dow. I know that sounds pretty bold, and maybe it sounds ridiculous to some, but the possibility of default is growing greater and greater, and it may very well be that the marketplace, Wall Street, wants to send a message to Congress to not take us into default. Maybe the best message they can send is a major dump in the Dow. How that impacts agricultural markets, I'm not sure. The only thing that could possibly be bullish from that would be an assumption that if the U.S. and the world is concerned about the U.S. going into a default, the assumption, the knee-jerk expectation is that the U.S. dollar gets a lot weaker. And it's possible that the dollar could get weaker for a period of time and go back to levels that we traded, a few months ago, but do so with some level of emotion and fear. That's a possibility. Some could look at that as being bullish commodities. I understand that reasoning. I'm not sure I agree with it, but I understand where they're coming from. I think a greater risk here is that the U.S. and the marketplace and the world looks at what's happening and the dysfunction in the U.S. Congress and the possibility that the parties at play would allow us to go into default. I think there's a greater risk that it's viewed as deflationary and negative to all commodities, and some sort of a panic mode type of situation. And I think there's another possibility that if the U.S. were to go into default, as bad as that would look for the U.S., the implications for the rest of the world's economy would also be horrendous, and maybe still the U.S. dollar might be seen as a safe haven and the best thing to own in a world of chaos. So I really don't agree with the argument that a default or a panic would somehow be bullish commodities. I really don't agree with that, but I think there is some understanding about how people could come to that viewpoint. But overall, I think we're dealing with a very concerning time, and with wheat, corn, and beans having a recovery rally over the last few to several days, and wheat having a nice rally over the last 3 weeks, say, I think all this stuff is vulnerable. I'm especially concerned about movement in the outside markets, and especially about the Dow, and I think you're looking at a certain amount of weakness there. So consequently, I think this whole government shutdown, debt ceiling, still is the biggest story affecting markets, and it's going to be interesting to see how that unfolds here during the next 2 or 3 weeks. For the DPP Grain Desk, it's been Duane Lowry. Thank you.